The last day of the October trading month just wrapped up, and what a win for the bears. And with the first 3-month losing streak since 2020 officially in the books, it hasn't looked too good for the bulls. But where there is grief, there is always opportunity, and in the last 2 days, we've seen a momentum shift. With the Treasury borrowing less than what is required and seasonal factors on our side, could this have marked the low we've been talking about for the past few months? With some crazy dark pool trades coming into the books at some very key levels, let's talk about what comes next. Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell. Let's get into it. It was a pretty green day everywhere with some pockets of red. I mean, Google and Meta did both post fairly average days compared to the rest of the market, but Meta is up 10% since the lows last Thursday. Nvidia down nearly 1%. That weighed on the mega cap 7, as well as a couple of the bigger names in healthcare, But other than that, again, it was risk on. But looking at the sectors, again, risk on everywhere, plus 0.65% for all sectors, with real estate and financials outperforming, and then comm services performing the worst out of all the sectors. Still green on the back of Google and Facebook, and an appetite for risk meant fear abated. We saw the fear and greed index push up from extreme fear just on Friday all the way into the fear category, and that just goes to show with how temperamental investors are. And to be honest, I cannot wait for the new sentiment data. I think it's coming out tomorrow, and I'd love to see what this number changes to. If this goes to 30% bearish, and we get like maybe 35% bullish, and it probably means that a lot of these investors are probably, buying at the top and selling at the lows and don't have any conviction really. And that's what you really need in the market. You really need conviction. That being said, is it time to buy now? According to BOFA's bull bear indicator, we are getting to really attractive levels. And this indicator right now is at 1.5, and I believe every Friday they release the new iteration of it, and it's quite. If you actually look at 2022, when it hits 0, this indicator does hit 0 often. COVID, 2020, 2016, you can see 2018 right here, 2012, 2008, 2009. This indicator is really great at picking lows, and we are below this 2 level right here, which is the extreme bear buy now reading. But this indicator is largely for stocks. What about other risk assets? Now this is asset class valuations, risk assets versus defensive assets, and you can see risk assets are still fairly expensive, whereas defensive assets are still fairly cheap. Now, I don't really like the Z-score that much, and a lot of this is being, and for example, with defensives, it's been heavily weighed by treasuries. But let's talk about defensives. We can have a look at gold right here. So CTA exposure to gold, and these are pretty much just algos, guys. We can see that gold has had a significant run up in the last month, about 10%. And during that entire run, CTAs were shorting all the way down to, being short upward of 8% of their portfolios. Now they're covering at the top, and that's probably going to be supportive towards gold. Adding on to that, we saw the first inflows into gold from managed funds, and this probably means that managed funds are really liking what gold is doing right now. They see a bit of risks in the world, in inflation with the US dollar, the Fed, the government spending, and gold is looking very attractive for them, especially when you do consider that most people are severely underweight gold in their portfolios. And gold has actually been a pretty good investment this year. Now this chart is 2 days old, but I do think that the gold continuous contract and the SP500 index is performing at about the same level, about plus 10% for the year. If you bought gold at the start of the year and the S&P 500, you've probably done very well in your portfolio. Let's talk about treasuries. Bond yields are rising at the fastest pace since the early 1980s, and we know this, guys. This chart is probably a little old as well. We're probably closer to this level right here, 5.5%. Bond yields are rising, and it's probably a good time to lock in some of those yields. Against the S&P 500 earnings yield, you're actually making more money by owning treasuries, as you can see right here. So allocate some of your funds to short duration T-bills. But when will yields fall? Now, this is the Fed fund rate futures. Now, what are we expecting? We are expecting one more rate hike. The Fed fund rate meeting is happening tomorrow. We are then going to be expecting rate cuts as early as April, May, March 2023. 3 rate cuts to get to about this level right here, 4.25%, which is going to be supportive for equities in the long run. That's gold, treasuries, and yields. Let's talk about stocks. Earnings season is currently underway. We had AMD report earnings today, and they did pretty good. They beat on revenue, they beat on earnings per share, they grew their business 4% year on year and 17% on a GAAP basis. Pretty good stuff right there, and they did increase their guidance. Looking at early trade, they were up 2.5% for the day, fell after the bell on earnings, but you saw some very volatile action. They were down, I think, 3.5%, and then they, whipsawed up. So the algos came in strong. But AMD beat earnings, but was still down in after hours trade. And this is on the back of firms that miss EPS and sales estimates. You can see here that even if you beat EPS, beat sales, you're still getting sold into after hours into the next day trade. And a lot of the earnings right now is dependent on forward guidance. But what have earnings looked like so far? 70% beat rate, 705 beats, 302 misses. Now this is very, very good data, but the SP 500 has still fallen 2% in the month of October. Why? Everything is dependent on forward guidance. The market is not liking where the economy is, what the Fed, what the government is doing, the deficit spending, and they want to lock in growth, or they're just going to go put their money in a treasury bill. So that's earnings for 2023. Now, often a crucial and overlooked part of the market is tax loss harvesting. And we got this data from BofA right here. These are tax loss candidate stocks that could bounce. If you guys want to screenshot this is pretty much stocks that are down for the year from 52% all the way to like 10% here for Pepsi, even though Pepsi reported fantastic earnings. These are tax loss candidate stocks that could bounce. And this is positive for bulls because institutional tax loss harvesting selling often peaks in the October period right here. But let's talk about seasonality. So this is the October to November turn. So the last 2 days of October and the first 2 days of November, where there's been a 1% move the week before. So the trailing week, 1% move lower. What we get on day one is a 0.4% average day, 0.18% the next day. Day 3, which is the first day of November, which should be tomorrow's trade, we normally get a 1% up day. Now, so far we have had a very bullish week so far, but you have to play the probabilities. This stat has won 16 times, 2 losses. And then the day 4, the second day of November, we normally get a 0.5% return, 12 wins, 6 losses, for a total of 17 wins, 1 loss, with an average return over the 4-day November to October turn, 1.85%. So we're in a very bullish week, and we've seen that so far. Now, what about November? Let's talk about the month as a whole. So this is the November market performance, normal year, pre-election year, seasonality. And what normally happens in November is we get this massive spike up, which coincides with the October to November turn we see right here and right here. And then we get sort of this muted action towards the middle of November for the run up towards the end of November. But let's keep going. From here, it's only positive for the bulls. So this is the S&P 500 when the entire index is positive year to date, but down in October. A year to date return of this, an October return of this, what we normally get in November, what we normally get in November and December. We could see here that the average return in November, 2.4%, an average win rate of 72.2%, and then a 4.8% return in November and December, 88.9% clip. Very, very positive forward-looking stats for the year. And if you have been following me for the last 7 days, I pointed this out on my Twitter on the 25th, almost 8 days ago. The Q4 rally to commence if the S&P 500 manages to stay above 4150 to 4125 by the 11th of the 2nd. And we are slowly approaching this date right here. At the time, the price was this, and price begun to sell off heavily into last week, Thursday, Friday trade, where the lows were met on the midday Friday. And if we actually go into a chart, this is the S&P 500 year-to-date chart, and we highlighted this key zone right here, this high volume zone. And if we zoom in 3 months, we said that, like we said on Twitter, 4150 to 4125 was our key zone. We did breach below the key zone right here, but we did see a bounce, then support turned into resistance, resistance back into support. And we did say in yesterday's video, we want to see the S&P 500 reclaim this area right here, the 4200, and turn it into resistance. That happened. We moved above the 4200 mark, and now it's acting as resistance. Also, something to note, we did close this gap right there. And now what I want to see for the S&P 500 is for us to retake this high right there. That's the high I want us to retake. So the next target level is 4250. I want us to recapture this level right here, 4250, and potentially turn this into support over the next few trading trading days. Otherwise, it is very crucial to remain above this 4200 zone looking ahead to the rest of the week. But so far, everything's in favor of the bulls. Don't fight the trend. But let's move on to dark pools. So this is the SP 500 dark pools, and supporting our case, we saw some huge leverage come into the SP 500. And I looked at this trade. This was 8.5 million shares, and I can tell you right now that 418.1 area is very key. If we can get above this level right here, it probably means that these massive trades are probably longs looking higher, but if they are shorts, they're going to really look to defend this zone right here. Moving on to the Qs, and this is the last 2 days of trading. We saw huge trades happening here, and I did show you the leveraged ETF yesterday, and at around this level right here, what we want to see is this zone defended. If these guys defend this zone in trade tomorrow, if price does come down and they defend it, it's likely that these are longs and this is a long right here. However, we do know that they did not exit these trades because the amount of volume here was not equal to that. Very bullish action on the charts right now. The S&P 500, this could be shorts, it could be longs. Doesn't look that great, but on the QQQ, the Qs, it's looking a bit more bullish. Backing up the Qs, we could see here that yesterday I said that the 7th largest trade since inception on the QLD, the 2x bull QQQ came in here, as well as here, the 8th largest trade since inception. And this is a very key zone. We said yesterday 55.25 was a key zone. Price now trades at 56.42. It likely means these were longs, and what we want to see is that the 55.25 level defended heavily on the ProShares Ultra QQQ, and this actually coincides with this 4900 level right here on the Qs. A lot of confluence happening right now. If we see that line defended on the Qs and the ProShares, it's likely that these are longs because these trades are all in the same area of sorts. Looking at the equal weight, on the 25th or the 26th, last Wednesday or Thursday, I did alert you guys to this trade right here, the 2nd largest trade since inception on the equal weight. This is the 90-day chart. Looking at the intraday chart, what happened was this trade came in and then we sold, but there was no trades right here, and this is the 5 largest trades. They wanted to close this trade out. They probably would have right here, would have made a lot of money on that. Instead, they didn't. It looks like there was some small buys and small buys right here. The key for this is the 136 level. If we get above the 136 level and this zone isn't defended, I can tell you guys right now that this 2nd largest trade was definitely a sell. So everything is gonna depend on this 136 level right here on the RSP. And again, this lines up with the 316 and the 55.25 level on the QLD and the QQQ. There's a lot of confluence with all of these indices having large trades at very similar levels. Very telling. One thing I wanted to show you guys on the XLF, this is the the XLV, this is the healthcare fund. The 13th and 45th biggest, largest trade of the year came in, and healthcare has been, the last 90 days, not that great. I mean, no stock has been good the last 90 days, but particularly in healthcare, they saw a massive sell down in the last 90 days. But we've seen some very bullish price action come in here, and I don't think the big guys are going to short at this level right here, but I'll keep you guys updated. We probably want to dig deeper into the intraday, the monthly, to see key levels, but for now, just know that big trades came into the XLV at these levels. Now let's have a look at some unusual options activity. Something I wanted to point out, often we see the QQQ, we normally see a ton of puts to calls. Today, about 330 million calls to 485 million. Normally we see something like 200 million to like 1.2 billion, somewhere around there. So huge amounts of change happening in the QQQ as well as the S&P 500 Trust. Again, guys, we normally see like 1.6 billion calls to like 1.6 billion puts to 400 calls. There is some things going on the call and put value right there. Other than that, the usual suspects. That being said, take this with a grain of salt because it was a very low volume day. About only 32 million options contracts were traded. The average daily volume is just under 40 million, but 52% calls, 48% puts. And generally, that's what you like to see generally that's what you like to see considering the fact that it was like 54% puts last week Friday. So we have seen a rotation from puts into calls. Before we go, we do have some important data this week. Tomorrow we have the ADP employment numbers. We have ISM manufacturing, as well as the Federal Reserve decision on interest rates, Powell is speaking, and the quarterly refunding announcement. Very big day for economic data. And then on the 2nd of November, we have initial jobless claims. If you've watched up until here, thank you so much. I appreciate every single one of you. If you like this video, guys, please give me a like, comment, subscribe, share this video. Just help me out. You know I love you guys.